market conditions turned more unstable in May. In particular, the bond market sell-off in Europe was quite unprecedented. During the first week of May, the 10-year bond price lost 3.3%, something that has not been observed since the early 90s. At the same time, equity markets were slightly more volatile, and FX markets also experienced higher implied volatility. In this environment, hedge funds were quite resilient. All strategies posted gains in May, except CTAs as expected. The Lyxor hedge fund index in May was up 0.4%, quite in line with US equity markets and European equity markets as well. In May, the hedge fund outperformers were again long-short equity and event-driven managers. Long-short equity managers, and in particular Asian managers, have received continued support from the equity market rally in Asia. Meanwhile, event-driven managers were supported by market conditions as well. In particular, May will be reminded as the best month for US M&A ever. M&A volumes in the US in May were up to 240 billion USD, a level that we had not seen since May 2007. On the negative side, CTAs experienced a 5.7 drawdown in May, according to the Lyxor CTA Broad Index. The main reason for such a drawdown was the sell-off in the European bond market, in which CTAs had long bond positions, as a result of their trend-following behavior. They were capturing the lower bond yields of the first quarter and were caught by surprise by the sell-off early May. Long-term CTAs in particular were most impacted compared to short-term CTAs, and this is in line with our expectations since we had a preference for short-term CTAs versus long-term models. CTAs were also negatively impacted by the reversal in the currency market, with the euro in particular appreciating against the USD during the first 2 weeks of May. During the last part of May, market conditions normalized to some extent and CTAs were able to pare losses, but by the end of May again, volatility in equity and bond markets rose again, and at the end of the month, CTAs were down 5.7. This is the only strategy being down in May. Going forward, we close our recommendations to prefer short-term CTAs versus long-term models. We think that long-term CTAs, after the drawdown in May, should experience an upside on the back of the trends we expect as a result of the improvements in the US economy, which would continue to support the USD and put downward pressure on commodity prices, trends that CTAs would be able to capture going forward. On the event-driven side, we continue and maintain our overweight stance. We believe that the environment is very supportive and have now a preference for special situation managers versus merger arbitrageurs, where deal spreads are quite tight, and as a result, we have a preference for special situations versus merger arbitrage. Finally, on the long-short equity space, we have a preference for market-neutral players. As we get closer to the first Fed rate hike in September, market-neutral managers should be able to outperform in a context where market directionality is less supportive for long-biased long-short equity players.